Okay. Hello, everyone. Thank you for joining this evening session. Thank you very much to all the participants for joining us from far and closer. We have an interesting session on the European markets and the investability and the interest in European markets. I think we have a very interesting panel, have a bit of a battle of the continents. On this side, we have two renowned European investors that have allocated a lot of money to Europe, especially on the real estate side. On the other side of the panel, we have a US and a Canadian investor who are looking into Europe, see some challenges, and very interested in your views about how Europe could be more investable and what are your allocations are today. I will let the panelists take a few minutes to introduce yourselves and your background, and then we'll go straight into some questions on particular markets. Dr. Ludek, please.
Okay, my name is Ludek Sekyra. I am a real estate developer and investor, and my group, Sekyra Group, is the leading development company in Czech Republic and active across the region, Slovakia, Poland, and we have under development at the moment project in the volume 4 billion euros, more than 1 million square meters, mixed use, residential, offices, retail, and we focus on the large-scale development of the city district. And we have under development 3 largest city districts in Prague in the moment, several projects across Czech Republic and Slovakia.
Thank you. Rainer, please.
Thank you so much. My name is Schorr. Together with my wife, I run a family office, which we founded ourselves. We invest globally in various fields: mining, architecture, private equity, and real estate. Currently, we focus 99.9% on opportunity of century, which is a completely disrupted market in Germany. And we do it from Berlin and we do it from Abu Dhabi to capture as many capital as possible. We are the first European company which introduced Sharia-compliant investment funds at the ADGM in Abu Dhabi. So we don't cater, let's say, the Western world, but we also have access to capital from the Muslim world, in particular from GCC. And we invested with 2 different funds, and we invested in 2 different opportunities, which reflect the amazing situation at the German real estate market right now, which went through a crisis of a century. It never occurred something like this. Meanwhile, you can buy in central locations in Berlin and in Munich, you can buy real estate income producing or for developments for a fraction of the price you pay in Kiev. And this is this is disruption at its best. This is what we are doing.
Thank you. Please.
Hi, everyone. This is first of all, it's a pleasure and an honor to be here. My name is Swapnil Agarwal. I'm the CEO and founder of Nitya Capital. Nitya Capital is a real estate investor and operator of income-producing, low-income, affordable housing, multifamily units. In the last 14 years, we've touched about 100,000 units across 200 plus projects. Our current portfolio consists of about 15,000 apartment units, which are mostly affordable and low income in most of the Sunbelt states of US. And a lot of it, what he's saying is true, because we're buying stable, durable cash flows, buildings that are worth at a fraction of a cost for the replacement value. And we go an extra step because obviously this year, affordability is a key thesis, as we know. And so we're really trying to create a win-win-win solution for every stakeholder. So obviously we're return-oriented investors. So we're trying to create above-market yields, above-market returns. but at the same time, we are trying to, positively impact the tenants who live in our communities, which tend to be mostly immigrants, lower income families. And we, in our last 14 years, we have proved that they can coexist. We have exited, about 82 projects for $4 billion in value. We have a perfect track record. We're 82-0. We've never lost capital. We average 24% IRR. So through our work and our track record, we're in the process of proving that you can solve an affordable housing issue and generate returns. And there's a lot of initiatives, primary being we're in the process of tokenizing the equity interest, which will make the capital flow better, lower the cost of capital, which will ultimately have an impact on affordability of these tenants. That's one of the key areas that I'm very excited about. And at the same time, we're looking at across the world and, being prudent and deciding how to allocate capital between US and Europe.
Thank you. Tommy, please.
Thank you. And yes, thank you to the Davos Lodge for inviting us again this year. So my name is Tommy Baltzis. I'm the CEO and founder of the WhiteHaven Financial Group based out of Canada, Montreal, Canada. We're basically a financial group that guides people through this investment journey. We've got a division, WhiteHaven Asset Management, for wealth management. We have a U.S. equity fund, which this year in 2025, we're very proud of earning a grade A from Fund Data and a 25.34% return, which made us #1 U.S. equity fund in Canada. So we guide investment direction for if you want, for investors, if you want asset allocators to a certain extent. We've entered a world where passive investments or passive investing is a bigger challenge. So purchasing an ETF, you'll follow the market. We consider ourselves a little more active managers in that business that we do on the asset management side. So therefore, we're one of a group out of Canada advising internationally as well too on what's happening geopolitically, what's happening in the world, making people understand the decision making from business, capital flight, be it the Trump, obviously, and that's basically where we stand. And pleasure of being on this panel.
Thank you. And if I can start with you, I mean, your investors, from what you told me, mainly Canadian, do they ask for euro currency exposure? Do they ask to diversify away from the US dollar and the Canadian dollar?
Yeah, so I'm going to generalize here because obviously, like I said, we're asset allocators. It all depends on the type of investor, that's their profile. Some are more capital preservation, more focused on real estate. Others are younger, inheritance. Right now we have a big, we started into this generational wealth transfer. But the challenge we have, being a bit the topic that we have today, is Europe. Europe has always been a challenge to try to find return. It's a great place historically to have capital preservation. And these challenging times that we have right now, we're trying to find a solution to see how Europe is becoming more of an investable asset class, if you want, because the last 10, 20 years, there hasn't been much risk-taking in Europe. Obviously, that's why we see regulation. Europe really focuses on regulation. The challenge that we have with Europe is that a lot of times when we start looking at it is that not everybody is aligned. So we joke around sometimes saying, is Europe the United States of Europe as a unit, or is it more a geographical, geographically speaking, a gathering. Mm-hmm. So that makes it very, very challenging in that sense. And then you factor in, obviously, the AI that's coming in. Well, that's a major disruptor. So right now, that's what we're looking at. Historically, Europe has been a place where if you wanted capital preservation, we'd go to. There's some pockets, like, for example, Poland, that has been very good to us. We've invested in Poland through ETFs. and we've done pretty well. So I'll leave it like that for now, unless there's something else you want me to add on.
No, thank you. It's useful to see that. I mean, from my experience as a European investor, I think there are, even purely from the stock market side, there are markets that have performed extremely well, even more recently, but over the last decade as well, including Greece, which was a bit of a difficult case, but became an excellent performing stock market more recently. Going back to our two European investors, I have one question for both of you about the availability of financing. Obviously for real estate, the availability of financing makes a huge difference. How do you see the evolution of that over the past years, and is it still a tool that you can use from European banks and I guess from global banks to leverage your projects and build out your allocations? Rainer, if you'd like to.
Yeah, thank you. I mean, Ludek in Czech Republic and us in Germany, we represent total different financing availabilities. Why is Germany in such a real estate crisis? It's only due to not available capital. The Germans, they act in concert, the banks act in concert. The bank, 70% of the banking system belongs to the state itself, and when they burned their fingers, they don't touch anything anymore, to put it black and white. And one of the most important four letters in investing is WACC, weighted average cost of capital. And some 5 years back, you could finance real estate in Germany, in Berlin, with 0.5% interest, which means if the WACC is zero, the asset goes to infinite, and today it's the opposite. The WACC is infinite, and the asset goes to zero. Negative. And yeah, nearly negative, yeah. And so this is why I do what we do. I do it for nearly 40 years, and always in this stage of the cycle, we don't focus on German capital. Mm-hmm. We utilize the German capital in 2-3 years when it's back to make an exit, but the money is coming from the US and from the Middle East. And in addition, we see a big global move. South America, I would say number one, Middle East number two, to reduce the dollar exposure. And even if it's only 1%, it is 2-3 times the GDP of Germany. This is 1% if you put it into numbers. But I guess gut feeling, it's more than 1%. It's rather 2%, because a complete also the GCC is also US dollar because it's oil. This is the same of if you speak about dirham or rial, it's all US dollar based, and we see a shift. But where to invest in Europe? This is a difficult question. I mean, politically, the most stable country is Germany. So, and we have the best chancellor we ever had in history. And you are talking about regulation. So, and people think that Germany is overregulated. Somehow it's overregulated. But I can tell you, if you follow those regulations, you can drive 200 miles per hour in your Porsche on a German motorway. Within those regulations, there's nobody will disturb you. I can tell you, being also most of the time in the Middle East and based at the ADGM in Abu Dhabi, much more regulated from a financial standpoint than Germany, much more regulated. So Germany has its own character, but Germany, on the other hand, is the only country in the world, speaking about real estate, where if you buy a plot in the master zoning scheme and you don't want to have double the lettable area, you just follow the master zoning scheme, you are entitled to get a building permit. Yeah, nobody can hinder you. Also, objection from the neighbor. My dog was walking there, now you are constructing houses, doesn't work in Germany. So it's actually relatively easy-beasy, even if it looks from the outside different.
But how's the capital structure? Isn't it upside down in Germany right now? Like, what can you borrow for now? What can you borrow for now?
What you are producing is relatively easy to finance. Once a property is income producing, you get financing, let's say on a 75-80% loan to value, interest between 3 and 3.5%.
Is that positive leverage on the yield?
Yes,
Is positive
yes.
leverage?
Yeah, we are buying distressed loans. So nearly only distressed loans. So, and a lot of people invested, in particular in Berlin. After the reunification, Berlin was always sexy, and it started with an apartment building, 1990, with 500 euros per square meter. But given from the communistic part, there was a rent cap. In Berlin, the rent was only 2 euros. So, which means you had negative cash flow, but you have an expected capital appreciation, which indeed took place. So, it went from 500 euros, 1990, in 2021, the same building, no capex invested, to 6,000 euros, but the rent went from 2 euros to 15 euros. And this we are buying back now for 1,500 euros. It's a dream.
Opportunities, even in very developed markets. Dr. Sekyra, from your side, I think, obviously having built your business in the Czech Republic, you're extremely familiar with this market. And I think once you are in the market, you see the risk in a completely different perspective from an outside investor. But if you look at, but you invest also in other countries in your region. How do you see the sort of emerging Europe versus more developed Europe dichotomy in terms of pricing, availability of capital? And I don't know if you've looked also at, let's say, the Western Balkans, areas that are even more sort of developing or catching up to the standards. In your earlier panel, you mentioned that prices in the Czech Republic are now in the sort of 10,000, 12,000 euro, I guess, for the high-end market. How do you see the opportunities in the emerging side?
Yeah, so I will say there's difference between the old Europe and new Europe, because after the fall of communism, there was a huge demand for everything, and the structures of development doesn't exist. So after the revolution, we start with the development, refurbishment, these old concrete buildings. And what happened between the population is more and more richer. Yes. And what we see, demand is growing. The companies generally in the old Europe are much less indebted than the German real estate companies. And that during the recent crisis, we have no bankruptcies. Yes. Market growing up. Apartments in broader city centers of these cities, 10% every year. And I will say we should also differentiate. If we say Czech Republic, Poland, Slovakia, this is something different than the Balkan countries, Serbia, Croatia, even Hungary. There are two different sub-markets, because these first three markets are already institutional markets. We have a lot of institutional investors. They are able to buy office building.
From other parts of Europe, for example, French institutions?
French, German institutions. And now more and more local investors and local funds was created. 80% transaction with institutional properties, shopping mall, offices. Today in Czech Republic are local investors. Last year, almost all transaction was that from foreign funds was took over by local funds. This is not yet case in Poland. It's been the strong capital which invest a lot in the market, and Prague is a relatively small market. We have in offices 80% market share. So this is very different. From outside point of view, we talk with the friends from United States and Canada. It's very fragmented, the European markets. If you look in the German market, it's a very big market, but if you look on these markets, they are fragmented. But they offered you enormous opportunities.
Yeah. And I mean, this is a question to everybody, but And again, I mean, let's speak about real estate because I think it's the predominant theme here. What are the return expectations from the different projects? I mean, I think you have both developed projects and also maybe some more markets that would offer higher opportunities. Rainer, your projects seem to go through a distress cycle that may offer, let's say, way above average returns, above, let's say, classic real estate returns. And also, Swapnil, from your side, I mean, you mentioned your returns. Are they sustainable at these levels with current interest rates? I'm happy for all three of you to address.
Sure, I'll just start where you ended. So, look, in traditional form, we were trying to create a positive delta or leverage day one. So, for example, cost of borrowing at 4%, going in cap rate of 5%. So there's 100 basis point delta. Mm-hmm. That, you know, with 75% leverage, you're generating 8% cash on cash. And then what you're really trying to do is take that unlevered yield. For example, if you bought it for 5 by year 3 or year 4, you're trying to take it to 7. So you're trying to add 200 basis point worth of value, either through expense efficiencies or through, you know, rental increases. And then you're underwriting an exit cap rate, you know, again, 5.5. You can be conservative. So, you know, that was a traditional method, and that helps you create 20% plus IRRs and, you know, close to 2x equity. Last 3 years, again, the whole capital structure has been turned upside down because you have mortgage rates that used to be, you know, 3, 4, 5%. You know, before, you know, 2021, people were borrowing at 1%, 1.5%, and then you had the greatest hikes that Fed has ever done in the history of the U.S. by 500 basis points. So your borrowing costs, which used to be 3, 4%, is like 8, 9, 10%. So now your whole capital stack, which is, you know, designed to create positive leverage day one, it's negative. So you're basically like in Germany, where you're just waiting for the market to turn or for the yields to come down to exit, and that's what's created this mess, and it's going to create a lot more mess when it comes to housing and real estate, because the biggest factor when it comes to real estate is interest rates. That's the only correlation that, especially for rental yield income plays that we do. And in a market like this, it's very difficult to underwrite unless, you know, we're also buying from, you know, distress. We have great relationships with our lenders. You know, we survived the cycle without giving any asset back. So, you know, lenders have seen the performance. And so we're buying deals at loan basis, getting a very attractive seller financing back from that lender, putting very little equity down. So those are the unique distress plays. But, you know, in traditional sense, from 2013 to 2021, how I underwrote returns is completely different to how they will be underwritten now, or how they were underwritten last 3 years.
Understood. Rainer, from your side?
You can achieve extra margins in Germany, what you could actually never do on that large scale. I mean, Germany needs 1.4 million apartments. If you multiply this with 50 square meters and 5,000 euros per square meter, it's a 600 billion project where, given the drop in the prices, a 200 billion margin can be made. This is, so to say, perhaps the biggest market opportunity per se in any G7 country. So, and you can go to Berlin, you can go to Munich, you can go to Hamburg. I'm not speaking from the countryside, I'm speaking only from the top 7 cities in Germany, which is clockwise Hamburg, Berlin, Munich, Stuttgart, Frankfurt, Düsseldorf, Cologne. Mm-hmm. So, and cap rates from the beginning 11, 12, 13% and 3.5 to 4% loan if it's income producing. It is, I mean, you can go to GCC, to GCC, you have lower returns.
Yeah.
You have let's say, a lot of capital appreciation, expectation, but you have much lower returns. And you have private equity returns on real estate in top locations in Germany.
And from our last discussion,
you mentioned one important thing, and Ludek also mentions this. Unlike Middle East, unlike Ludek in Czech Republic, unlike a Tishman Speyer or a Heinz in the States, the German real estate market was fragmented among 7,500 development firms with zero balance sheet. If you combine the largest 10 in Germany, it would be 1% of Tishman Speyer, if at all, to put it into context. It's completely, nobody can understand why it is so, but it is as it is. And so when Putin in September 2022 cut the gas and Germany lost 60% of its cheap energy, the megawatt went from 50 euros to 500 euros and the construction prices went to infinite. And all construction firms canceled their contracts because of unexpected events. And from 7,500 development firms, 7,490 filed for bankruptcy. And if you are an institutional investor today and you come to Berlin and say, oh, 1.4 million apartments missing, rents doubled over the last 3 or 4 years, can I get 500 apartments newly constructed? And you go to Knight Frank or you go to Johns Lang LaSalle and say, deliver me this stuff. They say, sorry, there's no producer. In the capital of the third largest economy in the world with a AAA rating.
Thank you. It's a striking example, but how much of that is changing now? Because, I mean, you're doing this, you're raising money, from what you explained to me, through the debt instruments, you're acquiring properties or the rights potentially to properties. But how much of the other side is coming soon? I mean, is the capital being available through financing to the developers or somehow so that they can get back on their feet and recreate that capacity? Because it's not Ludek who will build the apartments in, well, maybe yes, but...
I hope he will.
Well, either someone has to bring in that capacity across borders.
We are cheaper than the Germans.
Yeah, you can put everything on a truck and deliver it. But these are challenges that have to be addressed. And Europe is small, but it's not that small. Do you see structurally, other than what you're doing, other firms trying to change this reality? Or the government, let's say, trying to change this reality?
The government is doing really efforts over efforts over efforts, and the new government put things in place which might accelerate a new building class. Just went through the parliament where you can low-cost housing with modular construction. Because the regulation in German housing was quite high because of energy standards. This is going down now. Construction costs came down from 4,000 euros to nearly 2,000 euros. So, but the terminal value of each real estate goes up day by day. I mean, you have to see Berlin doubled the rent in the last 4 years. So what does it mean for the terminal value? But 4 years ago, the construction costs were 4,000, and now they are 2,000. I'm speaking about modular. Simple standard construction.
Sorry, Ludek,
I will
please.
say I absolutely agree with the Rainer, because the German market is such fragmented that this is the challenge for consolidation. Yes, and this will come sooner or later. Will come, and who will be first there, and who will be able to mobilize the capital? Let's say the capital from Middle East is probably the largest concentration of capital. He will be a huge winner, and this will be the biggest profits in Europe. And I think the other markets, the smaller markets, are much more consolidated. Mm-hmm. One thing which is common for all markets today across the world is affordable housing. Affordable housing today is the political issue. And again, I think this idea with tokenization, this is the great idea, because this is a really political issues, and the part of this polarization is that the young generation cannot afford to buy on rent the apartment. And what I know also, the President Trump will speak about, will have talk about the affordable housing. So this is something what is the role of developers, role of the investors, long-term investors, because My colleagues are long-term investors. I'm pure developer. So I use the short-term financing, 2-3 years, and then we are selling. So, but the affordable housing is biggest challenge for real estate industry, and I think we all should think about this, how to help to create, to build more affordable housing, because this is one of the most important things for next generation. This is not only AI, this is also affordable housing.
I think we've seen a number of jurisdictions where the lack of affordable housing has changed cities completely, has destroyed some cities, and also leads to social unrest. Tommy, I'm sure you've taken a lot of notes from what you've heard. I think it's interesting to hear from your side, is real estate as an asset allocation pillar present across your portfolios through REITs or other type of instruments?
Yeah, so, I mean, obviously we have three panelists here that are focused more on real estate. On our side, it's exactly that. A lot of people have, when you're managing wealth, they have the real estate component, right? So if we're looking at REITs, we're looking at that aspect. On our side, what we look is long-term. Like we spoke about long-term plays. Investments are by definition something long-term. So we look at, like we said, affordability. Why is affordability being created these days? Going back to Germany, for example, birth rates are low. They lost the pipeline, the energy. BASF, a large chemical plant, put it down, shipped it to the US under Iowa, right next to the natural gas pipelines. So the idea is that, yes, real estate is a play. I mean, it's a hard asset. You can't just pick it up and go. There's a lot of movement, a lot of middle class have been created, a lot of individuals that are leaving their countries looking for another way. I mean, immigration, I spoke briefly about the biggest wealth transfer between the baby boomers and the next generation, but we're also looking at capital flight coming from multiple countries. I mean, China, India. We have the same problem in Canada. We have a huge problem of immigration. We're not having kids. Europe is the same thing. You look at, what's happening in Italy. You look in Greece, like we mentioned. France with the issues that they have as well too. So yes, you have all these issues that we encounter for Europe, and the question is, how do you invest for the long term? Yes, real estate is part of the portfolio, but it's not the whole portfolio, and affordability of it. It's nice to say, okay, we're going to fix the affordability crisis of the home, but at the same time too, what are the youth going to have as jobs? I know AI is the big thing that we're talking about in Davos and everything, in pretty much the whole world, but it is a big political tool right now. Like in the 70s, we had the energy crisis where the oil is basically what was the negotiation tool. Right now, we have AI that's really the challenge, and it's who's going to take the lead on it, because if you base your whole economy on AI, and then tomorrow morning, for example, if it's the US and Donald Trump doesn't like something and says, I'm pulling the plug, well, is your society going to crumble? It's the same thing with energy at the time. Now everybody's invested in trying to get that energy independence, so everybody could be on their own. But yes, there's major pockets of opportunity in real estate, but at the same time too is that real estate to house people, they need to have jobs. Like you said, in Germany, doubling the rent. How are people gonna be able to sustain that kind of rent? And then they have no disposable income to be able to spend it. We're a capitalist system in the world, so therefore we need a consumption-based economy. And there's not many consumption-based economies that are really run that way. There's a few around the world. So that's what we look at and say, yeah, real estate's part of the portfolio, but as an investable asset, even on the liquid side, like you mentioned earlier about Greece having a good stock market and all that, a lot of it has to do with immigration policies that, for example, right now in Greece, they have, if you come in and you, for the next 15 years and put your residency in Greece, you pay 100,000 euros flat tax. So, for example, what's his name, the tennis player, Djokovic or something, he's becoming a Greek citizen. He's paying a flat tax of 100,000 euros for the next 15 years of income generated outside of Greece. Italy had that. They brought it up to 200,000. Yeah. UK just put in a wealth tax, and there's a lot of people fleeing to Italy and Greece right now. So the short-term stock market is being inflated by capital flight going through. And this is a huge, huge problem. So you're going to have real estate that we've been used to historically, people not moving like this. The young generation would love to pay for an iPhone and live in an apartment than buy a house and put a fence. Things are changing rapidly. So, sorry, I just took a little more time.
No, it's true. It's true. I think the next few days will probably give us a lot more color on the geopolitical effects and how Europe will be also seen, let's say, from the US as an investable asset. Within the last week, new tariffs have been floated. Greenland is still on the table. So I think that will give us a lot of color on how that will affect the market. We're exactly, a few minutes past time. I'd like to thank you all for your comments. If anyone would like to make a closing comment, from my side, I think there's extremely interesting sort of pockets of value in Europe, and I think we have great examples of where these should be looked at from institutional investors and from private investors. I do believe in Europe, and I think, if anything, the new geopolitical reality might push for more unity, or at least I hope for that, rather than more fragmentation. That's all on my side.
Since I started, I'll end on my side. The one thing, I'll just keep it short, is just saying that when I go around, specifically around the world or in Davos, people ask me all the time, or in periods of abnormal, and I switch it around and tell them I actually think this is a normal time. The last 75 years, the Bretton Woods system that has been put in place has allowed the US to be the police of the world and build all these institutions to have this kind of order that we've put, and we've had the best, historically the best time in the history of mankind, and we're entering a period where we're moving from a unipolar world to a multipolar world. And in the past, the alliances were based on conviction and not convenience. And right now, every time for example, right now people ask me about Greenland, and I said, well, Trump has been talking about putting some sort of dome to protect its national interests. So at the end of the day, you just look at December, the national security policy that they came out is that's what they want Europe to follow the U.S.'s interests. The U.S. has been always there for Europe to a certain extent, and they're saying, well, Venezuela, Greenland, certain things are in our interests, and Europe runs to China and says, oh, well, they're the second biggest economy, well, we'll go over there. So right now we're looking at convenience a lot, right? So I'll leave it like that, it's going to be interesting times, and I agree with you. Trump is on his way, I think, right now, and we'll see what he says tomorrow, and the market can go up or it could go down. So.
We'll see.
I guess my closing remarks. So I'll just point out one stat, and it all goes back to, because this whole topic was about real estate. So if you look at, I'm going to compare real estate with stock market. So if you look at the total market cap of all real estate around the world, that's 400 trillion. If you add up all the market caps of all the stock markets of the world, that's 100 trillion. So real estate is an asset class that's 4 times bigger than the market cap of all the listed companies. Now here's the key stat. Every year, so in 2024, out of 400 trillion, 1 trillion real estate got traded. Compare that to a stock market, 100 trillion worth of stocks got traded. So you have an asset class where 0.25% of the total market cap gets traded every year. Compare that to stock market, that's 100% of the market cap gets traded every year. Crypto is 20 times the market cap. So to make real estate an investable asset class, we have to remove capital rigidity. REITs are very specific, one geography, US-based, and a lot of REITs are actually going private because market isn't giving them the right valuation. They're actually giving discount to the NAV. So tokenization is one route that we're taking. And I think, for real estate to become an investable, you heard Warren Buffett I think, say it before you retired, it's too complicated, it takes too long, right? A lot of these legends of an investors, they think it's not worth investing because you have legal complexity, identity, and title, and it's a very complex. Buying a real estate project or developing a real estate project is a very complicated process compared to how else you can make money, right? So ultimately, for real estate to succeed, and for Europe, US, whatever region, for real estate to flourish, you have to improve the access and liquidity in those regions.
Yeah, that's very important. Rainer, a closing
Very
comment
good.
from you?
Yeah. As the topic is investing in Europe, here a little bit, I come back, what is Europe? And Europe will always survive. And if you look in history, it was strongly connected to Russia, then it was strongly connected to the US. It will always survive. In particular, Germany will always survive. I mean, the most entrepreneurial country in the world, believe it or not, is Germany. I give you two numbers. Germany has 84 million inhabitants and has 4.5 million enterprises. So, France has 70 million inhabitants and has 600,000 enterprises. Put this in context. Daily you use here on the share, on the belt, on everything, on the plug, on the handle, on the bulb, on this thing, all German products. And if you look to Europe, I mean, you cannot only invest in Germany in real estate. This is the most obvious one, but also small and mid-cap companies in Germany are completely world market leaders and outstanding and the most innovative group of people, actually.
Thank you. It's optimistic and true.
So I will say that despite the polarization of the world, despite all the instability, I think the real estate will stay as the stable asset class because you cannot produce the land. This is unique asset. And, but you need to create the value. And the development is creation of value. If after we create the value, then the investors, as my colleague, can invest in this. So I think development is the best business in the world because create the most stable class assets.
Thank you, and you've done very well creating it on your side. Thank you very much to the panel. Thank you everyone for being with us. Have a good evening. Thank you.